This video is for the Chapter 13 lab. I know in the past I've gone back and forth between the book and between the lab problems, but for this specific lab, I'm actually not going to be going back and forth between the lab and between this, because I'd like to spend extra time kind of just talking about each one of these problems rather than going back and forth and saying the book says this and here's what this homework problem says. The book actually has a very extensive problem that it goes through between many of these scenarios. And so with this lab, we're going to start out by focusing on what is relevant information for when we make our decisions, and then we're going to go through 4 different types of scenarios using relevant information to make decisions. And those scenarios are very similar to the scenarios that are listed in the book already. So for this first activity that the lab has, is it's saying it wants you to distinguish between whether or not this information is relevant and how the costs actually behave in here. So what they've done is they've given you kind of a narrative problem, and they've given you 2 different types of candies, and then we need to determine whether or not the item is relevant and what type of cost behavior does this item have. So they start out with Gayla Ojeda is trying to decide which of the 2 different kinds of candies to sell in her retail candy store. One type is a name brand candy that will practically sell itself. The other candy is cheaper to purchase but does not carry an identifiable brand name. Mrs. Ojeda believes that she will have to incur significant advertising costs to sell this candy. Several cost items for the 2 types of candy are as follows. So here we've got the brandless candy, and it will cost $4 per box. The sales commission is $1 per box. The rental of the display space is $900 and advertising is $3,000. Here we have the brand name candy is $6 a box. The sales commission per box is still $1 per box. The rental space is still $900 for the space, but the advertising cost is only $2,000. So it says identify each cost as being relevant or irrelevant, meaning does it differ between alternatives. So it sounds like she's only going to do either the brandless candy or the name brand candy, one or the other, but not both. So it's relevant if it differs. It's not relevant if it doesn't. And then it says to indicate whether it's a fixed or a variable cost relative to the number of boxes that are sold. So we've talked about that in previous chapters. So that's kind of its cost behavior. Is it fixed? Are we going to pay that no matter what? Or does it vary by the number that we sell? Okay, so here we have cost per box of candy. And when I click on the drop-down box, it's given me 2 options. It can either be relevant or irrelevant. And what makes it relevant or irrelevant is up here, is it the same price, cost per box? No, it's not the same price per box. So if I'm trying to compare these 2 alternatives, this is relevant information. And so I'm going to type in relevant there. The next box is asking me, is this variable or is this fixed? So every time I buy a box of candy, it's going to cost me $4 or it's going to cost me $6. That means it's variable. If it stayed the exact same no matter what, then it would be a fixed cost. The next item is sales commissions per box. So here, the price for sales commissions doesn't change. So this is going to be irrelevant. With the sales commissions per box, though, it's $1 every time we sell a box. So that also means that this is a variable cost as well. Now when we get to the rental and display, or the rental of the display space, we can see that it has the exact same cost between alternatives. So that means that it is also irrelevant in our decisions. However, this one does not change. So that means this is a fixed cost. Advertising, if I look at advertising, it is $3,000 versus $2,000. So that means that it is changing between alternatives. So that means that this is a relevant cost. However, it's a flat fee. So if I sell 5 boxes, I sell 10 boxes, it doesn't matter. I'm still spending this $3,000 or I'm spending this $2,000. So that is going to be fixed as well. Now for the next question, this question goes into whether or not we should accept a special order. So many times vendors will try to see if they can get a cheaper price from another company, and they're like, well, if I buy this many of your product, will you give me a discount on that product? And a lot of times companies will give a discount on that product because basically they've got capacity to make more and they've already covered their cost. They've already covered some of these costs that can't be changed by selling other products at a higher price. And that's exactly what this question is going through. So it says Dalton Quilting Company makes blankets that it markets through a variety of department stores. It makes the blankets in batches of 1,000 units. Dalton makes 20,000 blankets during the prior accounting period. The cost of producing the blankets is summarized here. All right, so here it shows us this is a per unit fee, $10 per unit, $9 per unit, $1.50 per unit. So right there we can see that that is cost per unit. We have a batch cost, so it looks like they make 20 batches a year at $2,000 per batch. They have product level costs and they have facility level costs. So the actual cost for them to make 20,000 blankets is $33.75. So now down here it says Sunny Motels is offered to buy a batch of 500 blankets for $23.50 each. Dalton normally sells the blankets for $45 per unit. So basically what they're saying here is they're still going to sell all 20,000 blankets. They're not going to take 500 blankets out of this 20. They're going to sell these 20,000 plus an additional 500 to Sunny. So we need to determine which costs here are no longer relevant to having a special order, meaning which costs will, basically which costs are avoidable and don't include those in the unit cost. So if I'm going to incur this cost for making a blanket, I'll include it. But if I could basically avoid that cost, then that's going to be something that's relevant to me. So if I have to pay, I guess what I'm saying is if I have to pay the cost no matter what, whether I make these 500 blankets or not, then I'm not going to include that in my special order. If I can avoid the cost by making an additional blanket, then I would include that specifically in this special order. Okay, so as I analyze these different costs up here, only 4 of these costs are avoidable for making one more blanket. And when I look up here, the materials cost, I'm going to go on ahead and show my document camera here. The materials cost is one such cost that would be avoidable. So if I make an extra blanket, I'm going to have on here materials, it would cost me $10 every time I made a blanket. If I make another blanket, I'm going to have labor costs, and it says here my labor costs are $9 per unit. Manufacturing supplies, it's going to cost me $1.50 every time I make a blanket. In addition, I'm also going to have these batch costs. So every time I do a new batch, it's going to cost me $2,000. So here I've got a batch, and this cost me $2,000. So now what I want to figure out based off of these costs, because as I look at this, my product level costs, I'm going to pay those no matter what. Those are not based on how many blankets I make. It's just based on a fixed fee of basically running that warehouse. And then I have facility level costs. Similarly, those are things that are based on just being in business of selling blankets. I don't pay this every time I sell a new blanket. I just have to pay these costs to kind of as an overhead type of thing to cover different items that are costs to being in business of selling blankets. So really these first 4 costs are the only things that change every time I make a new blanket. So if I'm going to sell 500 blankets, what I want to look at is I want to say, I basically want to take this 500 here, 500 times 10. Well, that's going to cost me $5,000. Then I want to figure out how much is it for this $9 for the labor as well. Well, labor is going to be 9 times 500. So that means it's $4,500. Again, I'm going to take 150 times 5,000. And the 150, that's a little high, 1.5 times, 500 is 750. But then when I look at this, I'm also going to add in one batch. I'm not making more than one batch, I'm just making one batch because this is a one-time item. So when I add all of these costs up together, I have my 5,000 plus my 4,500 plus my 750 plus my 2,000. The total cost here is 12,250. That's my total cost that I'm going to incur. And if I'm making 500 blankets, this is 12,250 divided by 500 means that each blanket is then going to cost me $24.50. So what this company wants to do is they want to say, will you sell me blankets for $23.50? And I'm looking at this and it's saying, well, if I make 500 blankets for you, it's actually going to cost me $24.50 just in fees that can't be avoided. So at this point, heck no, I would not be willing to sell you any blankets for $23.50. My cost is $24.50, so I should not accept this special order. Now the next question here says, what if they offered to buy 1,000 blankets, buy one batch of 1,000 blankets for $23.50 per unit? Okay, well that's going to change my numbers a little bit because these items are not going to change, but this item will stay at 2,000. So let's see how much it costs me to make 1,000 blankets. Well, here it's going to cost me $10,000 for the materials. For the labor, it's going to be $9,000. For the supplies, it's going to be $1,500. And basically what I'm doing is I'm taking 1,000 times 10, 1,000 times 9, 1,000 times $1.50. My batch does not change though, because it's only one batch. So that's not going to change at all. So when I look at this, it's going to be 10,000 plus 9,000 plus 1,500 plus 2,000. So right here my total costs are 22,500. Well, if I want to figure out per unit what that costs, I'm going to take this 22,500 and then I'm going to divide it by 1,000 blankets. And when I do, that's going to be 22.50. So I'm taking this divided by 1,000 blankets. That gives me 22.50 per unit. So at this point, that is less. It costs, I'd make $1 a blanket. Is it a lot? Not necessarily, but it's still an extra $1,000 you wouldn't have in your pocket. So here, yes, I would accept that special order. And I mean, by accepting that special order, this is just a one-time order. So even though I only made $1,000 off of accepting it, because remember, when you're looking at whether or not to accept a special order, these things I'm paying out no matter what. So I really don't care. I've already got this covered when I'm looking at the 20,000 I'm going to sell. I'm selling an extra 1,000 blankets. So since these things are already things that are covered by other ways, I don't care about covering that. I only care about covering each one of these items here up top because these will change every time I sell a new blanket. That's the only reason I care. And by accepting this $1,000 order or this 1,000 blanket order by only making, $1,000 on it, I also may have a customer that will buy more and more and more from me. So it could turn into much bigger orders in the future as well if you would decide to accept that price. Okay. Next, number 3. All right, so here I've got, I'm trying to decide whether or not I am going to outsource making a product. So let's look at this in full, so that way it's easier to look at. I guess that's a French name. Lavasque Company makes and sells lawnmowers for which it currently makes the engines. It has an opportunity to purchase the engines from a reliable manufacturer. The annual cost of making the engines are shown here. So here they've got the cost for the materials. So it costs $26 every time they use those materials. The labor is $20 every time that they have to make a new engine. They have depreciation on the equipment. They have the salary of the supervisor who is overseeing the engine production. They have rental costs of equipment to make the engines, and then they have corporate level facility sustaining costs that are basically transferred into this business. So these are things where this would not go away if they got rid of the engines. So really, down below it says determine the maximum price per unit that Lavasque would be willing to pay for the engines. So if they wanted to look at whether or not to outsource it, how much would they be willing to pay for 20,000 engines is what you're really looking at. Because, and again, what I want to look at here is what costs will go away if I outsource this. So here, as I look at each one of these items, every time I make a new engine, it's going to cost me materials. This won't go away if I make an engine. Or I'm sorry, this cost would be here that I would have to cover no matter what when I would make new engines. So if I didn't make any engines, all of this would go away. Labor, it's going to cost me in labor every time I make an engine, but if I make no engines, then the labor goes away. The depreciation on the manufacturing equipment, it looks like I already bought the equipment. And so this is not an actual cost that's going to, I mean, if I stop making engines, I'm still going to have this depreciation. So this cost now became irrelevant in my decision because I still have to pay for the manufacturing equipment. Now, if I sell it, that would be a different story. But in this problem that they're giving us, it doesn't sound like this is going to be sold. So this is something that I already paid and I can't do anything about it. This cost just became irrelevant in my decision making. So these two costs have become relevant up here for the decision making. Now the salary of the supervisor, if I stop making engines, I won't need to pay a supervisor anymore. So this is a relevant cost. The rental cost of equipment used to make engines, I will no longer need to rent this equipment. So this is also a relevant cost. So if I'm making engines, this is relevant. If I stop making engines, this goes away. So that means that this cost is relevant to my decision. The allocation of the corporate level facility sustaining costs, this cost will be here whether I make engines or not. So this is now an irrelevant cost. If it won't go away by making an engine, then it's not relevant to any of my decision making whatsoever. So I only have 4 costs that are relevant. The cost of the materials are relevant, the cost of labor is relevant, the cost of my supervisor is relevant, and the cost of the equipment that I use, or renting that equipment, is relevant. Now when we looked at problem number 1, we talked about cost behavior. And we talked about cost behavior because that's going to go into how much would I be willing to pay for the engine. I need to determine, is this a variable cost or is this a fixed cost, because that's going to determine how much I'm willing to pay per unit for these engines. And so down here you'll see in requirement A and B, it says what's the maximum price per unit. So first I need to figure out how much does it cost me in total, because 2 of these are variable costs, 2 of these are fixed costs. So let me go on ahead and pull up my document camera here. All right, so I have my materials cost here. I'll just keep it on this part here. So I have my materials. My materials cost was $26 per unit. I have labor, and this is $20 per unit. And these are both variable. And then I have my fixed costs down here, which are the supervisor. And then I have the cost of the rental equipment. And those are both fixed. So no matter what happens, I'm going to be paying those out no matter what. So here, the first question said, how much would they be willing to pay for the 20,000 units? I guess that's listed up top in here. So they make 20,000 engines. How much are they willing to pay for 20,000 engines? So up here, the first one, I'll put a line here, is 20,000. Okay, so they've already given me what 26 times 20,000 is and what 20 times 20,000 is. So I'm just going to scroll over and look at those numbers here. So I've got 520,000. And then I've got 400,000 as well. When I take this 20,000 times 20 is 400, 20,000 times 26 is 5,200. Or I'm sorry, 520,000 and 400,000. Okay, now down here, these are fixed. So here it cost me $85,000 for my supervisor, and it cost me $23,000 for the rental equipment. And so if I add all of these items up, I have the that's going to give me $1,028,000. And to determine how much it would cost me per engine, I'm going to take that and I'm going to divide it by the 20,000. And that means it's going to cost me $51.40 to if I could buy that cheaper someplace else, cheaper than $51.40, I would. That would be a good price for me. Now the other alternative says, what if I could increase my production to 24,000 units? So here I've got 24,000. So I'm going to do the same thing that I did with this item here. This 85,000 is going to be the same, and this 23,000 is going to be the same. But these two items are variable, and it's in direct relation to the number of units that I'm making. So I'm going to look at this 26, and I'm going to multiply it by the 24,000. So for the first one, my costs are 624,000, and for the material portion, and then for the labor, it's going to cost me 24,000 times 20. It's going to cost me 480,000. And again, I'm going to add all of these costs up. And when I do, it's going to give me 1,212,000. Again, to figure out what it cost me per unit, I'm going to take all of this and divide it by 24,000. And that means that for me to produce, or for me to consider whether or not to do a special order or not based off of increasing production to 24,000 units, I would have to be able to get a better price than $50.50. So if somebody can give me a price that says, I'll produce it for you for less than these two items, and I felt like it would be the same quality, I would accept that price. But if their price is greater than this number, then I would not. Because the challenge is that even though I'm paying for this depreciation, and even though I'm paying for this facility costs, I'm going to pay for those whether I produce it myself or not. So those don't matter. All that matters is that these items would go away entirely if I stop producing those engines. And so those are the only ones I'm comparing it against. All right, our next problem is a segment elimination problem. And so I'll just go on ahead and read this narrative. So we've got Western Boot Company sells men's, women's, and children's boots. For each type of boot sold, it operates a separate department and has its own manager. The manager of the men's department has a sales staff of 9 employees. The manager of the women's department has 6 employees, and the manager of the children's department has 3 employees. All departments are housed in a single store. In recent years, the children's department has operated at a net loss and is expected to continue to do so. Last year's statements are as follows. So here, they're showing you what the sales are for each department. They're showing you what the cost of goods sold for each department is. They're showing you how much it costs for each manager's salary. So that's not like this manager is only working for the men's department. This manager only works for the women's department. And this manager only works for the children's department. So if we got rid of the children's department, this manager's salary would go away. Sales commissions are directly related to the department that they're in. So these sales commissions go to each person in those departments. The rent on the store lease has nothing to do really with the department specifically. So they're going to pay this rent no matter how many departments they have. So really this is kind of like a company level cost, and they've just divided it among the different departments evenly and spread it out. Likewise, the same thing with the store utilities. If the children's department goes away, you're still going to pay this amount of money in utilities on the whole building, essentially is what they're saying with this. So utilities isn't going to go away at all. So that's just going to be a cost that is still going to have to be paid. Now, when we look at their total net income, we can see here that the children's department is losing $8,500. The women's department makes $83,000, and that the men's department makes $63,000. $63,500, $83,500, and they're losing $8,500. Okay, so when I look down here, it says calculate the contribution margins. This one's actually broken up into 4 different parts. So when they tell you to calculate the contribution margin, they want to know, basically what would happen if we eliminated the children's department. That's what they're talking about with this contribution margin. How much money would go, would we lose money or not by basically eliminating this children's department? So you need to take into consideration what costs will go away, what income will go away, and ignore the stuff that will not go away for that contribution margin. So what is the children's department contributing overall to the entire store? Okay, so when I look at this, I'm going to go ahead and pull my document camera up again. When I look at this item, and I'm trying to determine whether or not to get rid of this children's department, I'm going to make this a little bit bigger. And I'm trying to determine whether or not to get rid of this children's department. The things that will go away if we get rid of the children's department is sales. These will go away. We won't have these $60,000 in sales. We also won't have cost of goods sold of the $35,000. So right now I'm just basically going down the line and looking at these items right here in the children's department. What's going to go away? Well, I'm not going to have any sales. Since I didn't sell anything, I won't have any costs to go with it. If I don't have a department, I don't need a manager, right? The manager will go away. And that is for $12,000. That will go away. I also am not going to need, I'm not going to be paying out any sales commissions. Just going to abbreviate that there. And that's going to be for $9,000. That's going to go away. However, when I talked about the rent on the store, I'm still going to pay rent on the store whether this goes away or not. So the total rent for the entire store is basically this $10,500 times 3, and then because I had 3 departments, I divided it by 3. That's not going to go away. That's just this portion here is going to be spread over this department and this department if I get rid of the children's department, along with the utilities. The utilities won't go away because they're still, it's one building. Yes, you can turn lights off, but basically to heat the building and cool the building, you're going to be cooling the whole building. So this is not going to really go away. This is just going to be spread over the women's department and the men's department. So right now, these 2 items won't go away. So that is not part of my contribution margin. And when I add this column up together, this is going to give me 60 minus 35 minus 12 minus 9. And that's going to give me a $4,000 contribution margin. So right now, the children's department is actually contributing $4,000 overall to the entire store. It may not seem like it because they have a loss of $8,500, but these costs don't go away. So it really is actually contributing this $4,000 to the overall store. If you get rid of it, you're going to lose profit of $4,000 because it's not negative, it's positive. So at this point, no, we really should not eliminate this department. That would not be a good decision. Part B says calculate the net income for the company as a whole with the children's department. So overall, if I look up here, what they mean by calculated as a whole is I'm going to take this $63,500 plus my $83,500 minus the $8,500. So overall, I've got $138,500 in net income if I keep the children's department. So that's $138,500. Okay. So then for requirement B, it says here, basically you want to figure out what is, or it says here, confirm the conclusion you reached in requirement A by preparing income statements for the company without the children's department. So really what I'm going to do is I'm going to pull information down directly from up top for the items that won't change based off of, or I shouldn't say, I'm going to pull information down that are based solely on that department. So like sales are based on that department only, costs are based on that department only, the manager's salary is based on that department only, and the sales commission is based only on that department. So if I got rid of these departments, these costs would go away entirely. So me getting rid of this department has nothing to do with these first 4 items. And so what I'm going to do is I'm just going to transfer this down number for number. So here, when I look at this, this is going to be $250,000. My costs are going to be negative $105,000. And then my department manager salary, that's not going to change either. So that's going to be negative $26,000. My sales commission is going to be negative $43,000. So far, this is identical to up top. I just printed this off and I'm just typing it right in. This is identical. I'm taking this 250, negative 105, negative 26, negative 43. And if you look down here, that's what I've typed in. 250, negative 105, negative 26, negative 43. And I'm going to do the same thing for the women's department. I've got 300,000 in sales. I've got negative 125,000 in costs. The salary for that manager is only 30,000, and I've got sales commissions of then I'm paying out of $49,000 on that department. So these things were copied directly from up top. Now the things I do need to actually calculate are going to be the next two. So I had mentioned that for the rental space, I'm paying that no matter what. So that means what they did originally is they basically took the 3 different departments and they spread this total cost out by dividing it by 3. Well, now I've only got 2 departments. So I'm going to figure out what this total cost is basically by saying, okay, 10,500 times 3, and that's going to give me 31,500. But now I can only spread that out over 2 departments because I don't have a 3rd department anymore. I've only got the 3 departments, or I'm sorry, I've only got the 2 departments now. No longer do I have the 3rd one. So I'm just going to divide that by 2. So that's 15,750. Likewise, I had this $2,000 in utilities. So that 2,000, I'm going to take that times 3 because that was my total cost of $6,000. But now I no longer have that to spread it over 3 departments. I can only spread it out over 2. So 6,000 divided by 2 is going to be 3,000 per department. So now I'm going to type these numbers in directly because these costs have changed because I no longer have an extra department to spread it out over. So you can see here the total cost is still $31,500 on the store utilities. I'm still going to have a total cost of $6,000. So now my income went down. When I still had that children's department, it was $138,500, and now the income is only $134,500. So it's actually gone down by $4,000, which is what we said in part number 1. We said, should we get rid of this children's department? No, because children's department is contributing $4,000 of profit overall to the company. It's helping to cover a lot of those costs. So if we get rid of the children's department, then we're going to end up losing $4,000, which is what we see. With the children's department, $138,500. Without the children's department, $134,500. So the last question says, in part C, eliminating the children's department would increase space available to display men's and women's boots. Suppose the managers estimate that a wider selection of adult boots would increase the store's net earnings by $10,000. Would this information affect the decision that you made for requirement A? Absolutely, this would affect the decision because what we showed in requirement B2 is that without the children's department, our profit is $134,500. That's without the children's. So without children's. But now, if we can sell more boots, then we can add 10,000 to this. This is more boot sales. So that means I no longer have a profit of $134,500. I now have a profit of $144,500. Instead, this is my new number. So before, if I wasn't going to be able to sell these 10,000 extra in boots, I would keep the children's department. But if I can get rid of the children's department and then sell an extra 10,000, $144,500 is actually more than the $138,500. So yeah, this information is absolutely going to affect my decision. And I would then say, yes, let's get rid of the children's department. I don't need that department anymore because now I'm actually making more money by getting rid of that department. Okay, so for the last question here, question number 5. It says, this is an asset replacement decision. So this is actually a very common decision that you would have in different businesses, is whether or not, new technology could come out. Maybe your old machine's not very efficient, so you have to spend more money on kind of maintaining that machine. This is a very common problem that's in businesses. You may even look at it from like a perspective of, should we move? Different things like that. So here, this is, it says here, Khan's company paid $240,000 to purchase a machine on January 1st, 2017. During 2019, a technological breakthrough resulted in the development of a new machine that cost $300,000. The old machine cost $100,000 a year to operate, but the new machine could be operated for only $36,000 a year. The new machine will be available for delivery on January 1st, 2019 and has an expected useful life of 4 years. The old machine is more durable and is expected to have a remaining useful life of 4 years. The current market value for the old machine is $80,000. The expected value of both machines is $0. Or the expected salvage value of both machines is $0. So it says calculate the avoidable costs in keeping the old machine and buying the new machine. So should the machine actually be replaced? That's the question here. So when you're taking this into consideration, there's some things we don't need to consider, and there's some things that we definitely need to consider. So when I look at this information here, what I paid for the machine in the past actually is completely irrelevant. I own the machine, it doesn't matter. So that is not an avoidable cost. I only want to look here at things that are completely avoidable. And when I'm looking at the cost of the old machine, that's not avoidable. So the next item says that I can get a new machine and it is going to cost $300,000. So if I buy a new machine, I'm going to have a column here that says old, and then I'm going to have a column that says new. Now if I do buy a new machine and I have to pay for that, that's a relevant cost, because now I'm forking out $300,000. It says here that the old machine cost me $100,000 a year to operate, and the new machine can be operated for $36,000 a year. So one thing I'm going to mention here, I'm just going to say operating machine. The one thing I'm going to mention here is that this scenario says we're going to use them for 4 years. So that's kind of like a big deal in my analysis. I can't just look at operating the machine for 1 year. I need to look at it for 4 years worth of operation. So it said here that it was $100,000 for the old machine for 4 years. So that means it's going to cost me $400,000 per year to operate this machine. So I'm going to put this $400,000 up here as a cost. The new machine only costs $36,000 to operate for 4 years. So if I want to figure out how much that's going to cost, I'll take $36,000 times 4, and that is $144,000. So I'm going to put that up here as a cost of the new machine. So far it looks like the new machine is still more expensive than buying a new machine. All right, it says the new machine will be delivered on January 1st. The old machine is more durable. It'll have 4 years. So this is the same. This doesn't matter at this point. And then it says the current market value of the old machine is $80,000. The expected salvage value of both machines is $0. Well, at this point, I can sell this old machine for $80,000. So by not selling it, that is an example of an opportunity cost. So I'm going to put that up here. If I don't sell this machine, I lose out on $80,000 by not selling it. So now I have all the information I need to be able to figure out how much this costs me. Well, for an old machine, it's going to cost me $480,000. It cost me $100,000 every year to operate it, and I gave up $80,000 because I did not sell it. However, over here, to get the new machine, it'll cost me $300,000 to get a new machine, and it cost me $36,000 a year. So if I add these together, it cost me $444,000. Now I want to mention this is not necessarily like a cash flow type of thing, because obviously if I sell this machine, I'll get some cash in, that can help offset some of these costs. The point is when you're looking at alternatives, you're saying, how much did it cost me? Well, because I didn't sell it, I did not get $80,000 in. That's what I care about. So I had to pay off $400,000 and I did not get the 80. That's why I care that that's there. So when I look at these costs, here it cost me $480,000. Here it cost me $444,000. So should the machine be replaced? Absolutely. Yes, it should. It's cheaper to buy the new machine than it is to keep the old machine. So I hope that was helpful. If you have any questions at all, please do not hesitate to ask.